everyone. Welcome back to VRIC Media, your most trusted voice in metals and mining. I'm your host, Darrell Thomas, and today we have the pleasure of interviewing a friend of mine, Kai Hoffmann of SOAR Financial. How you doing today, Kai?
Not too bad. Really good day to be chatting, Darrell. Thanks for having me back.
Yes. A lot going on in the realm of investing
Hmm.
in the sector that we invest in. And so just curious in your thoughts on gold and silver currently, as well as any of the other commodities that you tend to focus on. I believe copper is one of them.
Absolutely. No, lots going on. And it's really difficult to put that all under one, just under one roof and maybe in one short answer here. But it's looking constructive out there, right? Of course, gold and silver were sort of pushed around by geopolitics, which triggered inflation fears, which, triggered Fed rate hike expectations as well. And gold and silver were just sort of being, damaged by that sort of theory, by those thoughts. What could higher rates potentially do to the gold price? Because, of course, we all know gold doesn't yield anything. So, of course, interest is lower. And then, of course, due to the geopolitical issues we've seen on the globe, especially in the Middle East, of course, we've seen liquidity issues arise in the gold and silver space, meaning liquidity issues, not that there's enough gold and silver out there. It's really a lot of selling pressure. Investors selling, dumping their gold and silver into the market to raise liquidity so they can afford perhaps other things, especially Eastern countries selling gold and silver to raise money to buy energy. We've seen Turkey sell quite a bit of gold, 120 tons actually, 118 tons to be specific, to maybe to stabilize their currency, the lira. So a lot of pressure, of course, on gold and silver, and I'm quite happy to see how well it is holding up. It is acting a bit in contrary, though, like as we speak here today on, what is it, April 8th, I believe, the day after the peace deal has been announced, or at least the ceasefire has been announced. We're on our way to a peace deal, hopefully. But gold's trading up, of course, because now inflation expectations are lower because the oil price is being hammered 15% lower. You would think that when peace gets announced, or at least a ceasefire announced, gold trades lower while it trades higher when war breaks out. We've seen the reverse, actually, because the oil price here is the real main function that has been pushing the prices around. And today we're on the positive, on the receiving end of things. Not sure where it's leading all yet. I'm still nervous about what is coming out of the Middle East. We're seeing pipeline attacks this morning. Question is, who is attacking who right now? I think that is still up in the air, just from a very pragmatic point of view. Is it still Iran following through on threats they made prior to the ceasefire? Or is it perhaps other countries that have interest in no ceasefire and no deal for the Strait of Hormuz, for example? So long story short, constructive environment for the precious metals. Constructive environment somewhat for copper as well. You hinted at it. I haven't looked at the price action in copper, I must admit, this morning, but just looking at it, of course, we're going to rebuild Iran. Global recession fears might be subsiding a little bit since inflation fears are coming down, which all bodes well for copper in the long run, of course, as well.
Yeah, for sure. So looking at the need for liquidity, right? And so I think a lot of folks are like really seeing like how important liquidity is like during this time, and like gold being a source of that liquidity, where you have nation states that are like selling gold to cover like energy costs or whatever other obligations they have to take care of. They're selling gold. And so when war breaks out, it's kind of interesting, with when you have this flight for liquidity, this run to liquidity, but then you also have like this safe haven nature, and it seems like those are both competing with each other. I mean, because gold is still, I mean, for it to be holding up at, I mean, it was holding up at, what, 44, 4,500 for a while. And then I think this morning it was like at 4,800. It obviously spiked on the announce of like a ceasefire deal. Silver spiked over 75 and such. And so it seems like it's a coiled spring ready to explode as soon as like this, there's some solution or resolution out of this situation.
Well, we shouldn't forget that none of the underlying fundamentals that have driven gold and silver to the highs have disappeared. Right?
Yeah.
We still have tariff uncertainty. The U.S. is still in conflict with China when it comes to that topic. The U.S. debt situation is not getting any easier. The military situation, the increase in military budget puts additional strain on the budgets, on the debt situation. So none of it has really disappeared. Of course, we can all argue and we can make a case for it, gold and silver having been in perhaps in a mini bubble, having been overbought. I think we can all agree on that topic. A lot of people just ran into it and jumped into it. A lot of tourists on board that sold quickly as well because the trade perhaps didn't work out when they bought at $5,600 gold at the high. They came out of it. So gold and silver are behaving and holding up really, really well when it comes to that and that liquidity. Long-term holders are still in it for the same reasons they've been buying gold just before the war broke out. And we'll have to see where it leads to. But again, none of the underlying fundamentals, weakening jobs market, weakening economy, GDP growth in Q4, that was way before the Iran war started, was down to 0.7%. It's been revised downward twice. Recession, stagflation are coming back up here as main topics in conversation with our guests on Zor Financially as well, that we shouldn't be ignoring. And those bode well for gold and silver, because in those environments, the Fed has to cut interest rates, and that is super bullish for the precious metals.
Yeah, what do you think about the recent performance of the gold and silver equities? So obviously, I mean, many of them were selling off significantly. I mean, I think I was buying Wheaton precious metals at like $107 at one point overnight, and and it's just like those equities just got sold off significantly. So what do you think about the weakness in the performance of the equities, and then where do you see them now?
It was way over. There was a massive overreaction, of course, in the market. You always see it on the upside, on the downside. We've seen it, of course, running up. A lot of stocks overshot any feasible price targets. But we've seen it now on the downside as well. You use Wheaton Precious Metals as an example. There are many others out there that have corrected 20, 30%, GDX, GDXJ as well, because it's just easy to get in and out of them at the time. Some exploration companies probably were way overvalued going into the situation that have come down as well. I don't have a specific example for you at this point, but that has been fixed. So I think it's a more positive territory that we're in for the miners, very more constructive, because we're now getting the Q1 numbers out of the miners here in the next few days. I need to check when Newmont's usually the first one to report here comes out. But the main point is Q1 average gold price was way higher than in Q4. And it was around I think it was $4,900 on average in Q1. It was $4,100 in Q4. So even margin pressure through perhaps higher oil prices in the last 3 weeks or something, it's completely negated by the offset in higher gold price. So we're going to see record earnings. We have to be a little cautious when it comes to guidance. I'm not too worried that the companies are going to say, well, our all-in sustaining costs are going to explode here this year. I'm not really worried about that. Some companies have hedged their diesel. A lot of companies already have underground production versus like open pit production. So they're a little more sheltered from higher oil prices anyway, because they need less energy to process. They don't have a massive trucking fleet, for example, that they need to maintain. So I see a big opportunity in this space. Still a bit cautious because we still don't know how solid the ceasefire deal and the deal is in the Middle East, of course. So we're still holding cash in our fund right now. We're sitting on around 12% cash that we haven't deployed this morning. We were thinking about it. We were having a conversation, but we're fairly happy with where we're at. We're going to let this play out a little bit, let the market, like we've done on the downside as well, let it puke itself out before we sort of figure it out. Because we've seen it this morning. Like the reaction was very positive. Stocks jumped really like massively, but gold and silver have come back now after the open. So we have to see. I don't think the market fully trusts what's going on yet, and to fully trust neither in Iran nor the US when it comes to, of course, the message. The fog of war is still very, very thick. And I mentioned the attack on the Saudi Arabia pipeline. We're still waiting for confirmation from Saudi Arabia what actually happened. Who attacked the pipeline? We don't know. That could be a massive derailment when it comes to those ceasefire talks and peace talks that they're supposed to happen in the 2 weeks. And that's why we're a bit cautious. But as you said, the market generated massive opportunities, and we're super bullish the stocks once the dust has settled just a tad more, in our opinion.
Yeah, yeah, for sure. And for me, like I actually went in and I sold some equities on the bounce this morning. Went in and it was like, okay, yep. I started buying this at this price. It's at this price. I'm gonna go ahead and liquidate because I just not liquidate, but just sell some of this position because I wasn't fully confident that either side was holding up to the ceasefire deal. And I think even Pakistan came out and said, hey, both of you need to like stick to stick to the ceasefire that you agreed to. And Iran accused Israel of still bombing Lebanon and such. And so yeah, it's a mess. Just thinking about the Strait of Hormuz being continue to be closed, right? And what I'm hearing is that, from guests that we interview like Luke Broman, Lynn Alden and such, like, the longer this happens, right, the more damage that's going to be caused to the global economy and such. And it's still closed. And like we still haven't come up with a deal. Every day is passing by, days are passing by. I think we're over a month and a half into this conflict, almost going on a month and a half and such. And so just curious in your thoughts on obviously you're parked in some cash. Do you think there's risk for further downside?
I feel like we're fairly sheltered at this point. Like a lot of selling has happened. Of course, if gold dips down to $3,500 again, which I don't see happening personally, I think we're okay when it comes to the share prices. Of course, panic selling, liquidity raising could happen again, but that would also mean that the broader stock market would have to show much more weakness than it has. Like it has been very solid. The S&P is up 2.5% this morning, I believe. It's back up to 6750. Last I checked, right around there. So it is a constructive environment for all markets right now. But coming back to the Strait of Hormuz, the first ships are sailing through it. So we've seen 12 ships or so go through it. I was following Hormuz. I think there's an X account called Hormuz Tracker sort of shows who's going through it. And again, I haven't verified any of it. I cannot verify it. I don't have my own satellite to check who's going through the Hormuz Strait here. But that's very positive. That's why the oil price is under such pressure because it is open. Right. So it is flowing. The question is, will that hold? That's the big question. And we don't know, quite honestly. There's so many uncertainties. Based on the information we have right now, I'm really constructive on the stocks, especially the gold and silver mining stocks. And we've seen silver stocks react very positively this morning. So I'm really, really bullish when it comes to that. But again, there is that caveat. If anything happens, if one of the ships gets attacked, anything like I wouldn't say it's game over. That's the wrong term. But the floodgates might open again. And the U.S. already said, hey, we're standing by. We're not moving anything out of the region. We're standing by. We're waiting to see what is happening. And then, of course, you got the neighbors, Saudi Arabia, United Arab Emirates. They're ready to go against Iran as well if they get attacked more. And Iran already says, like, hey, if you start attacking like civilian infrastructure, meaning desalination plants or anything else, power plants, then we retaliate with much more force. Not sure if they can. I'm not a military expert. Not sure what that might look like, but those are the unknowns, and it's really difficult. So I'm really happy with the 12% cash position. Next week, I might put it all back into the market. We're a long only mining equity fund here at Kamabest. So we might go long and have maybe 2-3% cash left and add to the existing positions, maybe add a few. But that really needs to, the environment needs to show me a bit more at this point. And 12 ships sailing through it is a good sign. And I think we're headed the right direction. I don't want to be overly pessimistic here. I'm just being cautious. I'm working with other people's money here. So I got to value my choices here. And 12% cash is actually not that much if you look at it. So we're being cautious, but positive.
Yeah, I was recently watching a clip of Warren Buffett who was interviewed, and the interviewer was asking him like, "Oh, we've seen like a correction in the market, the S&P and everything's in correction territory." And Warren Buffett was saying like, "Well, he's seen the S&P correct 21% in a day." So he's like, "Yeah, this is nothing," and we know that Berkshire was sitting on a lot of cash. They're still sitting on a lot of cash and such. And so it seems like there's some folks that are more like, okay, we could see some further conflict and before and we don't want to deploy all of our capital yet. Some people are waiting for some confirmation out of this particular situation before they are willing to jump back in. And then you do have some people that are still in the markets that are getting experiencing a lot of the carnage right now. And so I'm curious in your perspective on what confirmations are you looking for? So obviously, when you have the ships that have passed through today, that's part of confirmation, right? What would help you feel more confident that this is something that you're ready to deploy some of this capital back into the markets?
No, I think a proper peace deal, of course, always helps. Like a solid peace deal that's verified by a third party, right? Not just one Truth Social account versus one X account saying we're doing this versus we're doing that. Because I honestly don't know who to believe. I'm not sure to believe the U.S. because they're declaring victory. Iran is declaring victory. Not sure who's the winner, real winner here. Because right now I'm only seeing a lot of losers personally. But we'll have to figure this out. There's going to be a long rat tail. It won't be over tomorrow. Right. Even like we just discussed, the Strait of Hormuz is open now, but there's a long lag effect behind this. Like we haven't talked fertilizer or anything. I'm not an expert in that segment, but a lot of issues that are still existing that will take a while. Petroleum reserves need to be refilled. Jet prices, like Delta gave some guidance this morning that was fairly, I would say, on the negative side because jet fuel prices are much higher. Southeast Asia will take forever to replenish and have enough access capacity again. It takes a while for the ships to sail through the Strait of Hormuz and get to Singapore, right? And replenish those storage facilities. Australia, other issues as well that are waiting. It'll take 2-3 weeks for the market maybe to realize, okay, this is we're good here now. Any further disruption could cause a massive upset here. I think we might have dodged the proverbial bullet here with a peace deal or ceasefire right now, because if this would have gone on any longer, the world might have been in real trouble. We've already seen people lining up at gas stations across Southeast Asia, and we've been having discussions with friends that are traveling. Like it's Easter break for us in Germany, and I'm traveling right now as well, as you can tell. But a lot of my friends went to Thailand and Singapore for Southeast Asia just for some warmer weather for travels, and we were discussing like, can you even come back? Right? Is that going to be an issue? And that was something that we've discussed only 10 days ago. Right? That hasn't really disappeared just yet. It's very fragile. And all those effects, and we haven't even talked about inflation expectations in the US. We get CPI numbers this Friday. OECD, I think, made inflation forecasts for the US of around 4.2% for the year, which seemed to be okay. Core CPI, I just spoke with Michael Leibowitz, and he's made an emphasis on core CPI, which excludes food and energy, seems to be steady. But the overall effect, like the lag effect, meaning, okay, you got to pay now $6 a gallon or so for gas in the U.S. I'm not sure what the average is. I was just in Seattle at the airport. It was $6.40 a gallon. The second you leave that Seattle urban, the metropolitan area, it gets a little cheaper. But let's say $5.50 a gallon. A lot of people cannot afford higher gas prices because they live paycheck to paycheck anyway. So having to pay an extra $20 or $30 to fill up your truck is actually a lot of money. Right. And it was really highlighted to me, and I make that anecdote in other interviews over the years. But I was in Idaho at a hot spring like years ago, and there was somebody sitting next to me from Salt Lake City, and he was a refrigerator repair salesman. We were just chatting, and he told me, it's like, I can actually make this trip because gas has gotten so much cheaper. Right. And it was a 300-400 mile drive, a 300-mile drive or something from Salt Lake. So that just tells you how fragile the U.S. consumer is, perhaps, as well, and that we're only seeing that now. Those the higher costs get reflected elsewhere. Maybe travel spending. So if you have to spend $50 more to go 300 miles, maybe you're going to stay at a Motel 6 instead of the Hilton. Right. And I'm making extreme examples here, but you'll see that maybe people will go less to the movies less. They'll rely more on their Netflix subscription. Maybe they'll go out to dinner less. Maybe you should short Olive Garden or something, right? For the next 6 months, right? Or, those are the effects on the main market that we're watching right now as well. And that'll take time to digest. So it's really interesting now because we're at the beginning of earnings season. All those companies, like even an Olive Garden, and we'll say, hey, this is what our outlook for the rest of the year is. This is what we're expecting. Maybe they're already seeing a slowdown. I don't know, because they haven't come out with those numbers yet. But that's something we'll be watching because that'll dictate sort of what do you call it, the direction of the main markets, I believe, over the next few months before we hear anything else. Of course, if the Fed starts countering that, and that's the other thing as well, because we get a new Fed president in May, theoretically, because he hasn't been confirmed yet. If the Fed starts cutting rates, for example, maybe surprise 50 basis point cut, and again, I'm just making things up here, just theoretical, then of course the market will probably be exuberant, because then all of a sudden risk off, and we're all going straight back into the market, and we'll see 70 to 100 points in the S&P probably next week. Okay, so there's a whole a whole tail, like the butterfly effect, like the ripples are massive. Like it's a big rock you throw into that pond, and those ripples, like it's difficult to grasp, but it's not going to, the ripples don't stop with the first one, right? There's going to be massive effects.
Circa 2020, we pivoted the entire company, turned on its head, brought in new management, George B., our CEO, who's built gold mines all over the planet, and we focused in on CK, copper cake. It was not reliant on drill holes and discoveries. We can go through this process, engineering, permitting, get towards a development stage asset. US Gold Corp is a near-term, low-cost gold producer in Wyoming. To learn more, go to usgoldcorp.com.
So you mentioned that the average gold price for Q1. So obviously, earnings season is coming up. All these companies are going to be reporting earnings and stuff, and many of them got to factor in like these increased costs and these other headwinds because of this war in Iran. On the other hand, you have the mining equities, the producers that are going to be reporting their, with the average gold price that's higher. I imagine the average silver price may be higher. I'm not sure. I'm not sure.
It was $83.72 in Q1, the average silver price.
Yeah. Okay, yeah, that's good. So they're going to be reporting that and such. And so the mining equities still seem like a good place to be, especially when you look at their all-in sustaining costs. And then also, the average price of the underlying commodity staying elevated compared to the other quarters, right?
Oh, 100%. You're absolutely right. So margin pressures we're not seeing. I don't see any big increases to all-in sustaining costs like you pointed out. We will see Q1 might be one of the last quarters where we see exuberant growth in margins because now, of course, the trend has stopped. Like, trees don't grow into the sky. Eventually, there's an end. And I think we're at that end right now when it comes to like margins. As I said, let me just unlock my phone here because I had the average price, I think, was $48.73. I just want to be exact here. Yeah, $48.73, and it was $41.50 in Q4 per ounce of gold, right? So we're still below that average price for Q1. So maybe Q2 will be weaker. So you got to take that into consideration when you're investing, of course, that the growth expectations might be limited. But at $4,800 gold, that's where we're at right now, the companies are printing cash. Analysts and others are having their long-term gold price forecasts around $3,300, $3,600. So there's still a massive opportunity left because all their evaluations are based on those lower prices. And if you do your analysis on spot prices, you'll come up with much cheaper multiples. And you'll see that a lot of the names are still massively undervalued when you look at that metric.
Yeah, for sure. So you like being in this sector, analyzing the metals and such, do you want to see like a sustained period of the gold price leveling off? Just curious, and what do you want to see as far as like the gold price performance from here?
Well, of course, I want to see gold go up to $1,000 every month, right? And that's the ultra positive outlook. No, what I want is certainty as a portfolio manager. I want consistency. I don't like volatility too much. Of course, volatility is part of the game, especially when we're in a rising market. But I like consistency. I want to say, hey, maybe next quarter we'll also have $4,800 on average. That's fantastic. I'm happy with that. That's amazing, right? So that's what I want to see. I want to see consistency. I don't want to see massive fluctuations of one quarter is down to 4,000. The next quarter we're up at 5,000, back to 42, 53. That makes it really difficult, of course. So what I look for is companies that still have like some growth opportunities left now that the gold price might be leveling off a little bit, which is absolutely fine. Like we want the tourists out of it. We want some consolidation in this space in general. That fast money that has been attracted in this rise up needs to get shaken out. That's normal. That's a regular process. in a bull market, 20-30% drawdowns, you've heard that before, are absolutely normal, Darrell. So I'm happy with that because it offers, as you pointed out, phenomenal opportunities to go back in and quickly make 15-20% just on the trading side. But even on the investing side, long term, I like growth. I'm not a value investor. Even the fund is geared towards growth, not necessarily value. I'm not chasing 3% dividends. That's just, who cares? I want the stock to do 30% in a year. Then I'm happy. Right? That's what I'm chasing. And that's what I'm looking for because I still think there's some decent growth opportunities out there, even in this price environment.
Yeah. So, how are you viewing silver right now? So, obviously, silver has, these unique properties. I mean, industrial, and also monetary properties. And silver, has been kind of, in this trading in the zone, between what 70 and 80 or whatever the case may be. So, just curious in your thoughts on silver moving forward.
Yeah, I'm kind of happy to see that silver was able to hold above $69-70 recently, because otherwise we probably would have seen 45 again rather quickly. I was concerned about. I'm not a chart technician, but that's where I saw the next support level. Silver, as you said, so supply demand dynamics, we all know there's a massive deficit. We've been in a deficit for the last 5 years, 200 million ounces roughly every year missing in the market that need to come from somewhere. Now, with all the military spending that we're seeing, we all know Andy Schectman made it famous. There's like 13 kilos of silver in a Tomahawk missile. I'm not sure how many Tomahawk missiles have been used up over the last 5 weeks here, but I know that silver needs to get replenished, of course. It looks like we're out of the recession fears are subsiding, so photovoltaic EVs and many of those industries will get another boost here in the coming months, hopefully, all depending on the peace deal, of course. But it looks constructive for silver. Where is it going to go? I think 120 was exuberant. It was way overbought. I think we can agree on that as well. But again, we're in a very positive consolidation phase. Silver was up 5% again today, intraday. That's massive. That's very volatile. And it shows its characteristics versus gold, because gold was only up 2.7% when I looked at it today. And silver was up about twice as much, 5.5%. Gold silver ratio, we're sitting around the 60 mark right now. It has come down from 104. Where could it go? If you believe a Keith Neumeyer, it might go back to 1-13 or so, or it should go back to 1-13. I think that's extreme, because what does that mean? Either gold is coming down or silver will have to spike up massively again. Not out of the realm of possibility. I love silver. I wouldn't call myself a silver buck, but I like silver for its fundamentals. Very difficult to replace. You just have to keep in mind it's 50% monetary, it's 50% industrial. So if the economy is lagging or we're getting any negative indicators, then silver might get slowed down at least, right? So that's something you have to keep in mind. I'm not telling you anything new here, obviously, Darrell, but just my opinion. I'm quite happy with the silver prices. I really have a hard time predicting it because it is so volatile and prone to massive price moves like we've seen. Could it spike up to $100 next week? Yes, it could. What would drive it there? It might be a supply shock. Maybe some of the mines are closing. Maybe the COMEX says, well, we don't have the silver that we need. We're stopping trading. And then, of course, all bets are off in that regard. Current price level, I'm happy with it. We'll see where it goes when it comes to like replenishment of miss out silver, let's call it that. But it's a constructive price environment. I love the miners right now. Actually, First Majestic was correcting a little bit this morning. I was surprised to see that given the environment, but all the rest of my portfolio in the silver space was green though.
Yeah. So obviously there's some folks in the silver camp that you have people that do some amazing work on this, Michael Oliver and many others who are predicting like, more than just triple digit silver, $200 silver, wherever we may go, in relation to that. And so, and right now silver sitting at, mid 70s or whatnot. You said it's not out the realm of possibility. And so just curious and like, I imagine you're not keeping it as a base case or a base view, of this high triple digit silver. Is that correct?
I don't invest based on expecting $200, right? Yeah. Like there's others out there say, hey, well, this stock should be a 10 bagger if gold silver reaches $200, right? Yeah. That's just not how I invest. Like I need to make money at these prices, right? It's really difficult to say these prices because they change massively on a daily basis. Yeah. But if the stocks can make money at $70, and I've seen quite a few companies come up with very high all-in sustaining costs, I struggle with those. Of course, they'll make a ton of money at $200. Those are optionality plays, but that's not how we operate. I like looking at solid businesses and not based on future dream prices. Like, of course, I want it to go to $200. Don't get me wrong, but we got to be a bit more realistic. I'm investing other people's money, so building my investment portfolio on hopes and dreams is not a strategy, right? There's a very valid cases that it'll go to $200, but I cannot use that case as a portfolio manager in my analysis of companies right now. Of course, if gold goes to $10,000, everybody will be printing cash and we'll be all sitting on 10 baggers and we'll be, maybe I'll buy myself at a little island like I've always dreamed of as a kid, right? But let's keep the horse in the stable for now and train it, and then we'll see where it goes. But hold your horses when it comes to that. Like, use the current prices, feel comfortable, own stocks that will make a ton of money in the current price environment and don't need higher prices to be safe. There are a lot of companies that have been saved by higher gold and silver prices out there. But that's not an investment strategy. I think that's buying lottery tickets and hoping that your number hits.
Yeah, for sure. So where are you seeing the most attraction in the market currently with the recent carnage and such? Where are you currently looking? Obviously, I mean, you're sitting on the sidelines with some cash and you're like, okay, I need confirmation of this before we deploy capital. But what's kind of what part of this sector is on your watch list?
Well, we're still following the major producers, mid-tier producers, I'd say, is probably the sweet spot for us still. We're a fund. We can even do private placements in small exploration companies, so we can cover the whole universe. But I see, like you pointed out, and coming back to that, but we've seen the big names correct massively. That's the first opportunity that we're looking at. Of course, mid-tiers have corrected as well. Like Cisco Development has come down almost back to our original entry price when we bought it in October. That's a fantastic opportunity to buy, right? So we like the developers. I still think it's a tad too early for the exploration companies, for the pure play, early stage exploration companies. It's too early for that still. We're seeing it in the numbers as well at Ore and Inc. Financings have slowed down dramatically over the last 2-3 weeks for obvious reason. Uncertainty is never good for anything in a high risk environment that we're in the mining space. But it's really the big names that we're going to start looking. Newmont has been getting quite a bit of attraction. Of course, it's an S&P 500 stock that have been followed. But there are other names in that space, in that category. We've added Centerra Gold this morning, for example, more of a mid-tier producer with growth, with lots of growth upside that we're liking, that has come back quite tremendously over the last few days. So those are the opportunities. I really like that. It's too early, in my opinion, for the explorers. There's great opportunities in there. I still think the market is not there yet, right? Yeah. For the fund. Personally, and we talked about this briefly before in the record button, I've actually deployed quite a bit of cash in early stage explorers. That's my personal portfolio that I don't run concurrent with the fund. In Argentina, I've just done a financing in a company that's trying to test out the porphyry targets in the Mendoza area. I see opportunities there. But that's me for my personal portfolio, which is way higher risk, of course, than the fund when it comes to that.
Yeah, you got a little more torque in your personal portfolio.
And I can wait it out, of course, right? I can take it 30-40% drawdown without having to report to anybody but myself. But then when the drill results come out, hopefully positive, I'll be sitting on those gains. But that's a risk I don't want to expose my investors to in the fund. I'd rather come in after the discovery. When it comes to that, doesn't mean we will do that exclusively, but as of right now, because I think the opportunity is still in the bigger names, to make it easy. We got to always, easy with an asterisk here, easier returns perhaps in the bigger names right now with way less risk.
Yeah, for sure. Okay, yeah, appreciate that. So, what else are you up to? What should the audience know? What are you up to right now?
Lots going on, right? Created a lot of opportunity for ourselves in the bear market. I've been doing this for 15 years, meaning I've been in the mining space for 15 years. The fund is only the newest addition to the Hoffmann portfolio, for lack of better terms. But we also run a conference out in Germany that's sold out. So there's a lot of interest from the companies, but also the investors in our space. So that's really good to see. Run the YouTube channel, which has been gaining traction here, Soar Financially, and you're kind enough to mention it as well. And we've always been seeing each other at conferences. So we're really keeping close tabs on the market through various angles. Like I brought up data that we track at Ore and Inc. When we look at financings, that's another, I would say leg to stand up, but it's another business unit perhaps, where we track all the financings in the junior mining space, which gives us really, really good insights of what's happening. So as I mentioned, financings have slowed down tremendously. So it gives us insights from the fund perspective. That's why I'm saying the money is not in the smaller companies yet. So that's how I can back up my statements here, because I got the data actually to prove it. So lots going on. Deutsche Goldmesse, of course, really looking forward to it here in May. I think the environment is still constructive. We tend to have a positive gold week when we host the conference. It's usually green, so knock on wood here that happens again. Usually May is a good month for gold, and then we'll see where we go here. Darrell, lots going on.
Is that going to be virtual? Is that going to be?
No, you'd have to come out in person, Darrell. We're hosting it in Frankfurt, so we'd love to have you out there one of these days. You get the opportunity twice a year, Darrell, to come out.
Okay. So you do this twice a year. Wow, that's amazing. So obviously, sold out conference. I mean, even the Rural Symposium like sold out. I think it's still available virtually or whatnot. But I mean, and VRIC was like, I mean, we had 9,000 people. So it seemed like these conferences, like there's a lot of interest in the metals, and the sentiment's still very high.
100%. And the investors, they look for opportunities now. They see the gold price, they see the silver price, and they're wondering, how can we benefit from this? Germany is a fantastic mining market, like it is in North America, and the investors are very keen. And we see buying come out of it directly as well. It doesn't matter if it's VRIC or the RIC Rule Conference, there's buying coming out of it. It's not just people kicking tires. There's actually investment money behind all of this in general. So that's very positive.
Yeah. I mean, we saw each other. Well, I didn't see you at PDAC. I took a picture of you in action at PDAC. it was hard to find you afterward. I think of 40,000, 60,000 people there or something. It was crazy.
Like 33,000. It was a record year for sure. But I think that was also a function because a lot of companies just brought more people out. Because I didn't see too many new investors.
Yeah.
At PDAC. I don't think it's turned away from that a little bit. PDAC is just pure an industry conference nowadays, less with the investment angle. So you got to take that with a grain of salt, but it was extremely busy, meaning the industry is positive in general. So if you bring out more people to your booth, you're obviously positive that you can either make more money this year, or you've made enough money that you can afford to bring out your team.
Yeah, exactly. Well, appreciate you for coming on the show, Kai. Look forward to having you back sometime. You all be sure to go check out Store Financial, the YouTube channel, and just all of the other things that you're up to. And so I encourage the audience to go check that out. Hit the subscribe button if you haven't subscribed yet. Love to have you support. Thank you, Kai, for showing up again.
Thanks for having me, Darrell. Much appreciated. It was great.